I've managed to build a multi-million dollar property portfolio in just a few short years, and I want to inspire and motivate other Australians that if I can do it, so can you. The Tailored Property Wealth podcast has been created to help educate, mentor, coach, and support you through everything relating to property investing to make sure you go out there and make a much better educated decision when investing in property. Please like, share, subscribe, and share this podcast with anyone who you think might see value in it. Welcome back to another episode of the Tailored Property Wealth podcast. My name is Casey Taylor and I am the host of the podcast. And today we're going to be talking about how to mitigate your risk as a property investor. Now for me, this is the second time doing this because I forgot to hit record the first time around. So first time for you, second time for me. So hopefully I don't stuff it up. Cool. Let's get into it. So mitigating your risk as a property investor. And obviously going in, taking that action and investing in property, we want to make money, right? And we want to build that wealth so we can travel more, so we can spend more time with family and friends. Whatever it is and your motivation for investing in property, we want to make sure it works and we want to make sure we mitigate our risk while we do that. We don't want to get stuck on one property like 70% of investors do. We want to build up multiple properties at least, okay? Because that's going to help us get closer to our goals. If one property is all you want to do, completely okay, but even more so crucial to get in and make sure that property is really low risk and it's going to perform long term. So I guess today I'm just going to discuss some of the most important things you can do to mitigate your risk. And the first one off the bat is surrounding yourself with a team of specialists. There's a number of different people that you need in your team to make sure that you are mitigating your risk. And the first one is a buyer's agent. Obviously, I'm a buyer's agent. You probably say, I've got a hidden agenda to push it, but you don't need to work with me. Whoever it is that you go out there and work with, having them in your team is really going to help mitigate your risk. They're going to have a really structured process to follow, whether you're an owner-occupied or whether you're an investor, to make sure that you're getting a quality property in the suburb that you want to live in, or if it's an investment, looking at the numbers, looking at that data and research, making that really educated decision when you're purchasing. Now, I guess another benefit of that buyer's agent is they can give you access to the remainder of the team. So you don't have to go out there and spend the time doing your due diligence and all that sort of stuff. Finding a good quality buyer's agent, they're going to have a team where they can introduce you to those people. They've been working with them for years. And because of that, you have the confidence that the team around you is a quality team. Okay. So buyer's agent is super important. And just remember as well, buyer's agents are becoming more and more common. So as time goes on, what will happen is buyer's agents are going to be the new norm, and it's going to be the same if you're selling. I would say 99% of people who sell a property go through a selling agent, and that will be the same for when you're purchasing. And just remember, this is majority of the time going to be the largest purchase of your life, right? So why would you go out there and make the largest purchase of your life by yourself? But then on the flip side, if you sell one of the largest things in your life, you're happy to go out and use a professional. So buyer's agent is super, super crucial. Second one is a mortgage broker, and a quality customer-centric mortgage broker that's passionate about customer service and going out there and sourcing the best result for you. And that does not always mean the lowest interest rate. Sometimes it's finding the policy that's going to allow you to get the borrowings that you need to go out there and make the investment property purchase or the owner-occupied purchase. Down the track, if you're getting to 5, 6, 7, 8 properties, whatever that number looks like, you will get to a point where you're going to need to implement trust lending. I'm not going to go into heaps of depth with that today, but a mortgage broker who understands trust lending, the benefits of that long term, is going to be an essential part in your team, and it's really going to help you elevate that property portfolio. That stems into the next one, an accountant. They need to have really good understanding of that trust side of things as well, right? And obviously the ins and outs and the benefits and the tax concessions that you get through owning property. Okay. Never go out there and make a property purchase just for the sole reason that it's going to save you tax. Because essentially what that means is it's costing you money, and it doesn't make sense to spend $1 to get 50 cents back, if that, right? Go out there, buy high quality properties that perform, and then over time, tax is unfortunately just part of making money, right? If you're paying tax, it means you're making money. So focus on generating income, building wealth. It's going to be super powerful. So broker and accountant go hand in hand, and they kind of bounce off each other at a point in time within the portfolio. So it's super important to get those right. Pest and building inspector, super, super, super important level of due diligence when you're purchasing a property. As a buyer's agent, we can definitely look at things, but we don't have that extensive knowledge around buildings, right? We need that inspector to go in with their expertise to analyze everything and identify if there's any major defects or minor defects that need attention, and then using that as a tool to go and look at getting things fixed with the property or looking at getting a price reduction. The next one, property manager, super, super crucial within the team. People want to go out there and they want to manage a property themselves, and it's probably one of the silliest ones to try and do yourself, in my personal opinion, because what happens when a tenant stops paying rent? What happens with a tenant that damages the property, and then you need to go and manage that and potentially take them to tribunal, and you need to understand legislation on that individual state. It just causes far more headaches if you're doing that yourself. And we are investing for more free time. If you're getting to multiple properties and you're managing multiple properties on an ongoing basis, you got rates notices and things like that need to be paid. It's going to cost you a lot of time. Whereas that quality mortgage broker in your team is really going to automate things for you. They're going to pay those sorts of bills. They're going to provide property inspections and complete those inspections and do due diligence on tenants as well, okay, mitigating your risk. So it's super, super crucial to get that property manager right. And the last one is a conveyancer solicitor that is super high quality, knows the in and outs of the legalities, due diligence on that individual property when we're going to purchase. So that A team of specialists is super important. It's going to help you mitigate your risk across many different aspects of the things that come with property investing. Okay. So don't sell yourself short. Don't try and do it yourself, because the reality is you can't do it as good as those professionals, right? I'm a buyer's agent. I do this day in, day out, but I have obviously a broker, I have an accountant and pest and building inspector, a property manager, because you need to still leverage each of those professionals and those experts in their given field. Super powerful. Thank you for listening to this episode of the Tailored Property Wealth Podcast. I hope you're learning lots and getting lots of value out of this episode. If you want to discuss the opportunity of working with us here at Tailored Property Wealth, jump across to the website www.tailoredpropertywealth.com.au, complete the contact form, let us know that you're listening to the Tailored Property Wealth Podcast, and let's reach out, let's have a chat and see how we can help you execute on your property goals. Second one is the data and research-backed approach. Investment focused is obviously super, super crucial, but even if you're going out there and you're purchasing your owner-occupied property, there's still levels of due diligence and data that you can analyze just to make sure that that property is still a quality property while matching it up with obviously where you want to live and what meets your criteria for where you want to live. Okay, so that one is a super, super important one. If you're finding a buyer's agent to help you with that, if you're not going to do the data and research yourself, make sure it's someone that has kind of gone out there and and build a portfolio, and they're in a position that you want to be in as well. Okay, it's super, super important. Now, the third one that we're going to talk about, and I bang on about this one all the time, is CoreLogic did a analysis of the different asset classes and property types around Australia. That was released off the top of my head. It was August or October 2022. And over the last 30 years, houses in metro locations outperformed all other asset classes, growing by 453%. So, what that tells us is over a long period of time, that asset class, based off history, is going to outperform all other asset classes. So, if we can go out there and understand which asset to target and which asset not to target, that's going to help us mitigate our risk. Okay. And it kind of bounces into the next point that I want to discuss and what not to kind of purchase. And that's your house and land packages. It's your off the plan purchase where it might be a unit and it's one of 200 units and there's no scarcity. You own very, very little land component because it's a high rise apartment or whatever it is. Those products, you will find that there is what's technically a selling agent pushing that stock for developers, and they'll be positioning themselves as your buyer's agent, acting on your behalf to help you purchase this property. Really good question to ask is, how do you get paid? Because they majority of the time will probably charge you 2, 3, 4, 5 grand. And you think, yeah, that's super affordable versus what a buyer's agent would charge, for example. But they're charging you such a small fee because what's factored in the purchase price of what you're paying is the developer's marketing costs and the commission that the developers are going to pay that salesperson. Okay. Super, super high risk. It's super high risk when you're getting valuations done. Valuations can come back in lower, and it's just something super, super important not to get stuck in. And some banks just won't kind of touch that new stock because they understand the risk profile of those assets. So make sure you do your due diligence on what sort of asset is that you're purchasing. Okay. Now, kind of heading back into that same notion is the location as well. Not the individual product itself, but the location. If you're focusing on a small regional town that might be a mining town, it's booming and you get in, and this is where a lot of people get stung. If it's that area is solely reliant on one industry type, mining, for example, then that's super high risk. And if mining takes a downturn, the main income in that area takes a downturn, borrowing capacity takes a downturn, and in turn, property prices correct a lot more. So what we do as part of our analytics, I should say, can't talk, we focus in on industry sector of employment, and we want to understand what different employment types are in that area. Okay. So if one industry goes backwards, there's a lot of other industries there to support borrowing capacity that's still churning over in that local economy. So it's a super, super important one to analyze and understand. Okay. So that's kind of that one in a nutshell. Just make sure the location's correct. Make sure the asset that you're purchasing is correct as well. Getting into the market as soon as possible. Everyone wants to sit on their hands because they think it's super high risk, especially when we've just kind of gone through this rate rising cycle. People are scared. They're scared that it's going to cost them $200, $300 a week to hold. But then on the flip side of that is they're probably saving $500, $600, $700 a week. There's some really good savers out there, but they're scared to take that risk. And it just means the reality is your cash surplus is going to be a little bit lower. The capital growth you're getting is just far outweighing that saving. What that then means, and I've seen this in the last probably 12 to 15 months from the start of last year, a lot of people were getting scared with the interest rates. And based on their borrowing capacity, they sat and didn't do anything. And now they're priced out of purchasing a property because prices have, in some areas, have grown, I would 100K at least. There's definitely areas that have grown more, but they now can't get into the market for one, so they're going to continue to get priced out. So the opportunity cost, they now can't grow that wealth base. Or if they can afford, they have to go out there, go to the bank and borrow more money than what they could 12 months ago to purchase the exact same asset. So then your cash flow long-term is going to be higher even when rates go down. So it's having that long-term mindset, that forward thinking, and not getting caught up on just right now. Okay. So get into the market as soon as possible. I always say the more you delay, the more you pay. The more you pay, the more you borrow. Okay. The next one, and people get caught up in this with the whole crypto thing. I don't like crypto. I'm a property man. It's obvious. But don't try to get rich overnight. Some people try and go with the super risky strategies and go straight into a development or things like that. Make sure you're just building simple foundational properties in the portfolio to start with, and you're starting to build wealth and creating equity. And then once you've got a couple of properties under your belt, that's when you can diversify, take that little bit higher risk in the development side of things. So don't look at property as it's going to make you money overnight. You're not going to be rich overnight. It is a long-term play, and take those properties that are going to consistently perform long-term. And the last one that really helps mitigate your risk as well is purchasing under market value on the way in. So absolutely worst case, if something happens and the property sits flat for a short period of time or whatever it is, you've made 20, 30, 40, 50K on the way in, and you're just giving yourself a little bit of a buffer there if things do correct a little bit. If you're going out there and buying a 600K asset, but you've made 20 or 30K on the way in, you've got that 5% buffer of equity that you've just made. So if it kind of corrects a little bit, you're back to square one, which is great. But for us in building property portfolios, if we can make that 5 to 10% on the way in, buying really well, and then we're in that area that's prime for growth, it just accentuates that capital growth. And that's why in 12 months' time, we get really good results. Capital growth wise, because we bought well, but then the market continued to move as well. So it's super important. Sometimes that means that finding the property takes a little bit longer because you're waiting for that property where you can make money on the way in, but it's got the long-term fundamentals and the small 1%ers that make sure it's quality. But it's well worth it to mitigate your risk, but also the performance side of things. So this one's a pretty short one today, guys. It's just a number of different things that you want to make sure that you're implementing so you can go out there as a property investor and reduce that risk, because that's really what we want to do. We don't want to put ourselves in a position where it's high risk. And taking action, purchasing property, purchasing a really big, large asset can be done in a low risk way if you do it correctly. Okay? Don't take the shortcuts. Make sure you're doing it correctly, and it's going to be well worth it to reduce your risk. Okay. Thank you for listening. Another episode done, episode number 4. I hope you're enjoying. If there's something you're not liking, please let me know, and we'll make sure we're improving episode to episode. So thanks for listening. Thanks for tuning in, and look forward to the next episode. Have a good one. Bye. Thank you for listening to this episode of the podcast. If you don't already, make sure you follow us across all of our social platforms. That can be Instagram, YouTube, LinkedIn, Facebook. I wish you all the best out there on your property investing journey, and I hope each decision you make in purchasing more property gets you closer to your goal of financial freedom.